Hi, Bruce Miller here. Wow, what a day. Any way you look at it, whatever investments you were in today, besides having 100% in cash, you've probably taken a battering today. Whether it's bonds, whether it's precious metals, oil, and of course equities. Everything was down significantly today, and for the most part over the last few days. So I just wanted to take a few minutes of your time and tell you what we think is going to happen over the next few days in light of the turmoil that's going on, and try to give you somewhat of an inkling of why we think this has occurred in the first place. So what changed in the last 3 days that took us from brimming overconfidence in the markets to a crushing defeat which saw the Dow down over 4% and emerging markets crushed even more? Gold was down $90 an ounce, one of the largest drops that we've ever seen in that particular commodity, and silver, of course, followed suit. So what caused it? Why the difference? What does 3 days difference make? Well, everything revolves around the Federal Reserve right now. Ben Bernanke spoke and people listened. The interesting part is that he said what investors wanted to hear, but then investors started to question the things that he said. It's very complicated, but the Federal Reserve is having a heck of a time trying to figure out how to get out of this quandary of how are we going to get out of this stimulus-based investment scenario. We see good things happening, and I want to emphasize that we have seen many positive reports economically, domestically. The real estate market, as you know, is recovering quite nicely. We're seeing wonderful new industries develop in the United States. There's an energy revolution going on in the United States, which might make the U.S. energy independent within a few years. Many, many positive things are going on. But one big problem is how are we going to get out of this stimulus-based investment economy? The Fed has had interest rates at zero for so long and have been buying bonds for so long in the marketplace, treasuries and agency securities, that they just don't know how to wean that back without causing turmoil within the markets. But I want to tell you one thing. I do think they're taking the wrong approach by hemming and hawing about when it's going to happen, when it might happen, because I've talked about it before and it is still true. What the market hates is uncertainty. I think we'd be much better with an approach with a Federal Reserve that was transparent about what they were going to do, and granted the market might not like what they hear, but at least there would be some certainty to it. We may see an adjustment that might be painful at times, but the adjustment would come, the adjustment would go, and we would move on as an economy and as a stock market. So in my view, uncertainty is one of the things that's causing the turmoil in this market, and I would just like to see more transparency on the part of the Fed. It's not going to be easy. So what do you do? You know, we were very aggressive at the beginning of the year after the fiscal cliff problem subsided, and actually things went quite well. We had the drop in the payroll tax of 2%, and the consumers never missed a beat, kept spending the money. We had the tax issues, didn't seem to have a big effect. And of course we had sequestration, which was the automatic budget cuts that occurred in the Defense Department and in other parts of the government, primarily in entitlement programs. Again, we did see some impact there, a little bit of impact, but the economic recovery has been so strong that it has worked through all of these issues. And I can't emphasize how strong of a recovery it took to cause that to happen. So I think things are very positive. Even today, housing starts were up 6%. Leading economic indicators were up a small amount, but at least they were up. again, really good economic reports. But until we can get out of this cycle with the Federal Reserve, we may see continued volatility. So what's an investor to do? You know, I remember many years ago, you may remember it too, the crash of 1987. I was very young in the industry at that time, and I remember sitting in my office with all the other professionals watching the market fall and fall and fall. And you may not remember, but the market at that time, the Dow was about 2,200 at its peak, and the market dropped in that one day to 1,700, which you can tell from the percentages is an enormous drop for that particular time. So what happened? Well, you know, I had a fellow professional that was in an office next door to me, and he was calling all his clients vigorously, calling each client saying, I think we should get out of the market. I think we should get out of the market. Well, he got a lot of his people out of the market. But the next day, after that 22% decline, the market reverberated back with about a 7% gain that day, and it never looked back. Who was hurt in that situation? The only people that were hurt were the ones that panicked and left the market as it was dropping and sustained those losses, and probably had a very difficult time re-entering as that market continued to progress forward. And we've seen it time after time. 1989, another mini crash, similar. Of course, you all remember Y2K. And I fondly remember cruising in the Mediterranean Sea on a cruise ship in 2008 when we had the meltdown of 2008. It was very interesting at that time to visit Turkey over 3 successive days and watch the Turkish lira drop by 12% in a 3-day period. So we've been through this before. But what I want to tell you as an investor is set your allocations before this happens. And if this kind of thing happens, we're not panicking. We went from an aggressive cash position to a more conservative position in the beginning of May. And, you know, of course, in these situations, we wish we would have gotten more cash out of the market, but we did what we thought was prudent. And that's what I would advise you to do. Recheck your allocations. If you can't sleep at night, make a change, but don't make a change based on panic. You know, the market is ruled by greed and fear, and the ones that are the losers are the ones that sell into fear and buy into greed. So I want to tell you there are many, many positive things going forward in this economy. We have many floors. I'm not saying the market's going to go up again tomorrow. It may continue to drop, continue to be volatile. But what I want to tell you is that there are many positive things going on in this country and will continue to be. So if you can't sleep at night, reset your allocation, but don't do it in a panic mode. I still believe that there are positive things to be done in this investment environment, and Ben and I are going to do our best to make sure that we take advantage of that. So until the next time, be a little patient, don't panic, and continue to maintain a positive attitude. Thank you.